Hey everybody, welcome to the Chinchilla Pickin' Podcast. It is August the 2nd, 2021. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. Brandon, it is already August, brother.
It's crazy, isn't it?
How many months have we been doing this now? Every week, week in, week out, folks, by the way. We've been doing this a while, and we've kept it up, and it's been fun.
I don't know how many episodes. We're over 20 now, so it's been over 20 weeks. I think 23 episodes now.
Man, we should celebrate at 50.
We need to. Yeah.
Some kind of big celebration, giveaway, something. I don't know. We should do something.
And then 100, and then we can do 200.
Yeah. I'm all for that. Let's do something fun, huh? Something not too fun though, because I've had too much caffeine in my body today, and I'm just gonna lose it if we go too much fun here. All right, guys. So as always, I like to go over the rules. They are Brandon and I get together about 5 minutes before the show. This was literally today, 5 minutes. But we get together 5 minutes before the show. We do not tell each other. We do not discuss what we're going to talk about. We just tell each other what we're going to talk about. That way you hear the live interaction and discussion right here on the show. And sometimes we get caught off guard. I feel like we're going to get caught off guard today, man. I have that feeling.
I think so, too.
It's going to be interesting. But I wanted to start the show, and Brandon was okay with me doing this. So I'm going to start the show with kind of why we do this, why we started this podcast, what our goals. I know at the beginning, end in every show, I say we want to be entertaining, educational, uplifting, and we want everyone to make money. Well, that's true, right? So how do we want everybody to make money? Trading stocks through investments or day trades or options or whatever have you. We try to give you the mistakes that we made and have you learn from our mistakes and, get past those first couple steps. Because I tell you, when I first started trading stocks, I didn't have anyone out there really giving me any kind of guidance, and I lost every dollar I put in that first account. And you learn a lot along the ways doing that.
We don't want you to go broke in the stock market and then have to start an OnlyFans account. That would,
yeah, have one fan. I would only have one fan. Who? Now you're wondering. See, I got you hooked. Boom, salesmanship, people. So, yeah, we want you guys to learn, take something from this. We give you picks, yes. We don't always give you picks. Sometimes we just focus on, here's what happened here. Here's how you can learn from this, and here's how you can look at and find this going this way in the future. Look for these particular signs. Look for these value deals.
So, for some people, OnlyFans wouldn't be a rock bottom, but for me, it would be.
Yes. I mean, if you follow us on Instagram, you've seen our pictures. There you go.
Yeah.
Yeah, we just sincerely, honestly want to help. We do everything for free. We take time out of our day. We enjoy this a lot. We could literally, there have been nights that we've finished the podcast and we've stayed along talking for 2 more hours about stocks.
And we could have recorded those. We could have made, new episodes out of those, probably.
We could have a new episode every day with how much extra talk we do about stocks. That's how much we enjoy it. That's how much we love what we do, guys. And we want to share that passion with you, that enthusiasm, and we want to go over these things with you because we want you to learn how to read the market and make positive trades day in, day out. I'm going to segue this into the next section about that competition we have going on. Today was our first day of our friendly competition with the Money Viking podcast and the Money Viking folks there. I'll have to say I haven't heard how well they've done, but I know the Chinchilla Pickin' podcast is already up over 2% in just one day, folks.
If they were making money, they'd be talking. They're not talking.
That's what I think. Nobody's saying anything. I posted so we all have a group chat where we're talking trash to each other, and I posted a video letting them know that we made over 2% today, and nothing. You can hear a pin drop. It's funny. I will say Bob did say LOL.
That's not bad. To buy a stock like we did this morning, and it was DD, and I don't even remember what time it was. I woke up and I literally I was laying in bed on my phone, and then we made the decision to buy DD whatever time it was, and then an hour ago, it was all right, let's sell it. and cash in the money. So, 2.5% or something like that is what it was. That's not bad for a day at all.
I mean, that's awesome, dude. Yeah. That's awesome.
Now,
I preach every week on here. I preach 5% a week. You're halfway there, and you're only one day in a week.
Yeah, and it's so interesting in the stock market how time is a premium in stocks, right? So sometimes you want to buy a stock and you want to hold it over the long term so you can get 70%, right? But if you can take in one day what might usually take a week to do, then you've just bought yourself more time to make more money.
Exactly. And more time to really review the market and find, maybe another opportunity that you weren't looking at before because you're in something.
Yeah.
And so we did not post that pic today like we're trying to on our Instagram as to like, hey, we told Mark this, but we're covering it right now in our podcast. We did do a DD call today. It took a drop down over the weekend. Not much of a drop, but it dipped down. And I didn't see a need for it, considering that over the weekend there came out positive news about the Chinese working with American regulators there and trying to communicate back and forth. I knew in conjunction with that positive news, a dip coming into Monday, people are going to be looking for opportunities to buy. That's the macro event I'm looking for. People want to put their money in something on Monday mornings. You also had the macro event of the Chinese news story reaching out to the American regulators. You have a number of issues there pointing to, hey, we're going to get a nice little tiny bump, not a big bump, but enough for us to put some money in and make some money real quick.
Well, and then last week, the Communist Party had some conference calls with large American brokerage houses as well, trying to ease their concerns.
Exactly. So, I mean, they're all in all, you put that together, guys, and this is why we let Mark know. He's the one running the competition. We said, hey, DD's our call today. Go ahead and buy it. And then it took a nice little move up for us, and we went ahead and said, hey, go ahead and sell DD. We don't always day trade, but today, why not? Why not take a little over 2% in one day and, have fun with it?
Mm-hmm.
I think we spent enough minutes on this, man. You ready to get into this?
Let's go.
Today? All right, let's just do it. So I have an article, and I want to discuss this with Brandon because a number of things. I've covered this a few times. Actually, a number of times. I'm not going to lie. Brandon's covered this a few times, but the reason why I'm bringing up this article is it covers the same time frame and deadline that I've been preaching for the past few weeks. I'm going to read the headline. You guys can find this on CNBC. This is a CNBC article, so I'm going to give them all the credit in the world here. It says, Fed Governor Waller sees reduction in bond purchases possibly starting in October, right? Sounds great for someone who, wants the Fed to start unraveling that and stop pumping money into bonds so that bonds can actually do what they're made to do, and the equity markets can be actual, real, and not just fake pumped up equity markets, right? That's what we're looking for. So in the article, if you read in here, and I'm trying to get down to it, guys, it's taking me a second here. Okay, he is looking for, in September is what he said, he's looking for the next 2 months, August and September, to have job increases on the jobs report, the monthly jobs report. He's wanting to see around 800,000 new jobs. And I've always said September is crucial. Now, the reason why I've always said September is crucial, guys, is COVID policies of what is that thing where you can't be kicked out of your property you're renting out or mortgage.
Yeah, the moratorium on evictions.
Yes, the moratorium on evictions. Thank you, Brandon. I appreciate that. A moratorium on evictions, the unemployment benefits, all those Fed programs come to it in September. Boom, done. No more, right? You can still get your local state benefits if there are any, but most states have cut the extra benefits, and they're just the regular, everyday that we've had before benefits, right? So what everybody's looking for is these job numbers to be substantial growth after that. So what you'll see is why I'm saying September is crucial for the actual movement of people, but you won't see those numbers till October. So that's what I'm looking at. But he's looking at actual September numbers. If he sees a September number of 800,000 plus, he says that the Fed is good to go ahead and start tapering the very next month, and they'll do an announcement, quote unquote, late September. First thoughts off the top of your head, Brandon.
The only thing that'll potentially get in the way of that is the fact that we apparently haven't peaked in COVID Delta variant cases yet. And I think that I mentioned last week that Dr. Scott Gottlieb from CNBC said we're 2 to 3 weeks out, and I know those predictions have kind of been all over the place, but I do think he's a smart guy. If that's the case, if it's 2 to 3 weeks out, now we're a week into that, so it could be 1 to 2 weeks out that we peak. But we've got some COVID fears, COVID scares coming in the next 2 weeks that are probably going to hit the stock market. And then I don't know if that'll affect employment or not. It depends on how bad the COVID variant gets. Now, when those interest rates do start to rise, that will affect potential future tech valuations, right? So you'll see less.
Explain that to me, because I'm not even getting how you just jump from bonds and QE tapering to tech prices rising. Explain that transition.
Because people compare these things to bonds. They're all traded comparably, right? Apple.
So if a bond goes up, you're saying that Google will go up.
If the bond price goes up and the yield rate goes down, there's often a correlation between the NASDAQ moving up as the bond yields drop. As long as they don't drop too low. There's a sweet spot there.
Is that something you use as an indicator usually?
It is. It is. A good way to do it is just to take the annual EPS of your company and then measure it against the 10-year yield. And the way that you can do that is take the annual EPS, divide it by the 10-year yield, and then you'll get a price. And if that stock price is below that, then generally you're good to go as long as you have a good company. So let's do a little
let's give a little example for everybody here at home. Take a random company. Something that's been around let's take GE. You want to take GE?
Well, here, let's just say this. If your company's earnings per share has a earnings per share of 6 for the year, and where we at? The yield the last time I looked is 1.25%. Right?
Yes. Yeah, around there.
So then divide it by 0.0125, and then what you're basically getting is you're getting the price of the stock. If you bought it at this price, then theoretically you'd get the same return as if you were to buy the 10-year yield. And so if you have 6 divided by 0.0125, that equals $480. So say this is company X, theoretically, you buy it at $480, then you're going to get a 1.25% estimated return for the next year. It's just one way of looking at it and comparing it. That's a terrible return, so of course you don't want to buy it at $480. You want to do some math and buy it at a lot lower, but That's how you compare your stock's earnings yield to a 10-year yield.
All right, cool. That answered my question. Sorry.
You're good. And generally speaking,
you thought you were going out before.
The reason that tech is more vulnerable to higher yields is because tech has higher valuations built into them already.
Gotcha. You're talking about like the projected growth.
Yes.
That's already built into the stock.
Yeah.
PE with the future growth.
Yeah.
Gotcha. All right.
Now, the one way you could play that is if you do think that the Fed is going to start reducing their bond buying, which they need to do, and it should be done soon, I think banks are a good play. And value is, too. Really? Value stocks are fine, too, yeah.
All the banks, now see, I keep the banks in a watch list, and they typically all move in sync. The charts all look exactly alike. They all have the same curve and dips and valleys and everything. You know, if they're doing the head and shoulders that day, they all do the head and shoulders. They follow in sync. You know, Simon says. And I always look for a bank that when everything took a dip down, it didn't need to take a dip down because its fundamentals are sound.
Right.
and that's the one I buy every single time.
Well,
but you got to know the fundamentals ahead of the story breaking.
Banks are all following each other right now because every investor in every bank has the exact same concerns, and that's low yields. Because banks tend to make less money when yields are lower, or worse, when they're flattening.
Gotcha. See, I mean, right here, guys, I want to talk to our audience here for a second. This is the exact reason why you have Brandon and David on the show, right? I went into why I picked Dee this morning, and it was completely opposite reason, and kind of. It's like how Brandon gets to his picks. Brandon is very analytical and uses his education and smarts there, and I go. I don't want to say off my gut, but I go off my experience. I go off what I see in the news. I do all of the macro events. What are the news saying? How did this move last? Why did it move that way last? And, I believe this one should jump up because it didn't need to move that way. It got pulled down because of the broader sector. I'm looking at different macro events. And this gives you guys all a different look of how to find trades. He's talking about the yields in tech and maybe look at the banks if the Fed does taper. I look at it as like, for me, I'm a day trader. I prefer day trading. I do have some investments I do hold long term, such as Cooler and DD. I hold in those long term. But as a day trader, for right now, I'm going to day trade all the way up until that September jobs report. Then I'm going to cash out right before it because I don't know how it's going to hit. And I'm going to wait and see what happens and then put my money in. And that's what I'm going to do because I day trade. But if you don't day trade, if you invest, that is something to keep in mind, is the possibility of the Fed tapering and how it could affect your rates and your interest rates and the financials such as the banks.
Well, even swing trading if you're trying to be ahead of the curve. So if you're planning on buying something and selling it like a month out or something like that, you always know that the market is going to react to something before it happens. It's going to try to price those things in. So
yeah, exactly. 100%, sir. All right, I'm going to hand it back over to you because we discussed the article. I think we covered where we were at. We even talked about the two different ways here. I'm going to hand it back over to you because you have a pretty in-depth study of a company you want to cover. Go right ahead, Brandon.
So General Electric, very, very highly covered downfall of a once great American company. If you're a GE owner and you opened up your Robinhood app this morning, okay, don't trust what you're seeing because they haven't done the math on this yet. GE did not magically become almost $1 trillion company overnight. The market cap on this is still $118 billion, but because of this reverse split, Robinhood thinks it's a $947.92 billion company, and that's not the case. So we're sitting right now at a market cap of $118 billion. This is a company that used to have a market cap at its highs of over $400 billion. And let's look and see how we got there. So there's a long history of this once great American company. This dates back to 1876. Where Thomas Edison opened a lab in Minot Park, New Jersey. The company that resulted from this lab was the Edison Electric Company. This was essentially the world's first research and development facility. This is where Edison invented the phonograph. Around the same time period, the Thomson-Houston Company was emerging. Eventually, the two businesses arrived at a stalemate, and they decided to merge, with banker J.P. Morgan funding the merger. General Electric was the result of this merger in 1892. And it was a merger between the Thomson-Houston Company of Lynn, Massachusetts, and the Edison General Electric Company of New York. Both plants continue to operate under the GE banner to this day. That's kind of interesting. In 1896, General Electric became one of the first 12 companies to list on the Dow Jones Industrial Average. And they stayed very, very much ahead of the curve in technology. They were very innovative. Over the last 140 years, they've had numerous Nobel Prize winners and scientists and engineers just innovating for this company. In 1911, they absorbed the National Electric Lamp Association into its lighting business. GE then established this lighting division in the headquarters at Neela Park in Cleveland, Ohio. The lighting division has remained in that same location.
That's the start of downfall. They moved to Cleveland.
I know, right? Oh, the city that had a lake catch on fire. All right. In 1917, they produced the first sealed refrigerators. In 1919, after purchasing the Macaroni Wireless Telegraph Company of America, they formed the Radio Corporation of America, RCA. GE then used RCA to sell radios. In 1926, RCA co-founded the National Broadcasting Company, NBC. In 1930, General Electric was charged with antitrust violations. They were forced to divest itself from RCA, which they would then repurchase later in the 20th century. In 1927, a man named Ernest Alexanderson of GE, he made the first television broadcast reception at his home. Then on January 13th, 1928, he made the first broadcast to the public in the United States. These pictures were picked up on televisions, so-called televisions, that were 1.5 square inches. Could you imagine having a screen of 1.5 square inches?
No, that doesn't even cover the scoreboard on my Husker football game.
I know, it's crazy. Prior to World War I, GE moved into a new field. It was aircraft turbo supercharges. This technology led to the development of industrial gas turbine engines, which are now used for power production. In 1935, they provided lighting for the first Major League Baseball night game. In 1949, they produced the J-47 jet engine, which is now, became the most popular jet engine in history. In 1956, they invented the toaster oven. In 1971, they introduced the first portable air conditioner. In 1981, GE had become a bloated bureaucracy, okay? They had gotten into way too many different things, and they were stretched way too thin. Then legendary CEO Jack Welch took over. Welch first laid off over 100,000 employees to trim inefficiencies, and then he started selling the businesses that weren't performing well. After GE turned the corner, he oversaw another 600 acquisitions. When Jack Welch took over GE, the market cap was only $12 billion, and this speaks a lot to how well this guy ran this company. By the time he left in 2001, the market cap was $406 billion. While most conglomerates were seen as bulky and slow-moving, GE became a role model that survived downturn after downturn across numerous industries. In 1992, they built the Mars Observer for NASA. Fortune magazine named Jack Welch Manager of the Century. Then, in 2001, after Jack Welch stepped down, his protege, Jeffrey Immelt, took over. Now, he tried to be Jack Welch, but the problem was he wasn't. He was a terrible investor. 4 days after he took over, as an omen to what was going to come for GE, 9/11 happened. And that cost GE's insurance divisions over $600 million. Then the Great Recession came along. This hit GE hard. This cut corporate earnings from $22 billion in 2007 to $11 billion in 2009. They had to take loans from the government that were over $100 billion. They had to get a $3 billion loan from Warren Buffett just to survive and not file bankruptcy. Part of the reason for that was that GE Capital was doing what we talked about a few episodes ago that banks often do. They were borrowing money to pay down money that they'd previously borrowed. And then once the recession hit and the credit crunch happened and they could no longer borrow money, then they were in trouble. Then, after that happened...
So hold on, they were just like a Ponzi scheme is what you're saying, right?
Yes, they were, okay? And after that happened, Jeffrey Immelt looked at GE Capital and said, this is too risky. We're not going to do this anymore. He cut about 75% of that company out. This used to be half of GE's revenue. So there's a huge hole in the income statement here for GE, and he was searching for something to replace that hole, and then he decided to take a controlling stake in Baker Hughes for $30 billion during the post-recession oil boom. While oil was going crazy, GE would later have to sell that for a 50% loss. In 2017, Jeffrey Immelt finally stepped down, and he was replaced by John Flannery, who only lasted 1 year, as he had no realistic plans to enact any necessary reforms except for to cut the dividend by 50%. That's all he did. So then, in 2018, Lawrence Culp, or Larry Culp, however you want to say his name, he took the helm. GE cut its losses from negative $23 billion in 2018 to only negative $5.5 billion in 2019, and then in 2020 they recorded a profit of $5 billion. Now, historically, a profit for GE at $5 billion would be nothing. But because they came from negative $23 billion to 2020 having a profit, that's a big deal. They have met or exceeded estimates in 3 of the last 4 quarters. They've cut total debt from over $109 billion in 2018 to just over $75 billion. Tangible book value increased from negative $46 billion to $249 million positive dollars. EPS went from negative 20.96 to 4.64. The latest quarter, GE beat estimates and raised its full-year free cash flow guidance for industrial operations to a midpoint of some $4.3 billion, $800 million over the previous guidance. This was actually, like, a lot of analysts has caught people by surprise. The biggest problem that people were having so far with Larry Culp's reign was that free cash flow wasn't growing. Now it is. So it's not an issue as much anymore, as long as he can continue to do that. Today, the market cap is only $118.9 billion, so there's still a large gap between where they were at their peak and where they are today. But I think this could be the great American turnaround story. They still power 1/3 of the world's electricity, and they are the world's largest jet engine manufacturer. Thoughts?
I do have a couple thoughts on this, man. So, yeah, it's a great turnaround story. To right now, they do their jet engine. What they did was they cut their businesses down to the ones that were most profitable. The jet engine one is the one that was most profitable, makes them consistently tons of money. It's always been profitable. If you work in the jet engine department, you're not going to get cut, right?
Mm-hmm.
Great division of GE. Love it. The electric power division. The power division. They do a lot of windmills, and windmills are going up everywhere. That's still a hot thing right now. Companies still want to show they're green, and they're 100% renewable energies powering their plants and warehouses and buildings and such. Right. Still a good play there, but you can also go a solar play on that because a lot of buildings put solar panels on top of the roof. Other than those 2 sections, though,
and wind turbines. Which was...
wind turbines were in electric power. I covered that. It was still a big thing going up everywhere. Other than those 2 sections, is that it for GE, though? It's just those 2 parts of the company. Do they not have any other sections that are looking to grow? Because if that's it, are they right now at where they're going to be at?
They were in just about everything, and they're still...
Were. Where's the key word, were?
But I'm glad they're not, because they were overstretched by a lot. And those wind turbines turned out to be the only mediocre investment that Immelt ever made, and he actually bought those from Enron.
Go figure, right?
Yeah.
Look, all I'm saying is GE right where it needs to be? Is there much more growth to the story without acquisitions or new products or new divisions?
We'll have to find out. I just love the way that Culp is managing it right now.
No. Well,
the numbers are doing great.
His numbers are amazing. He's turning the company around. He's turned that corner, so he's got it going in the right direction. I that's my only question. And I always question everything. I never take it. Yeah. I don't ever want to smack a gift horse in the mouth. You know what I mean? Mouse. Go figure. I can't even talk. And I do a podcast. There you go. But I always want to ask a question or two and make sure that this gift horse is real.
Yeah. Well, I don't want to tell people to put a ton of money into it. I think it belongs in your portfolio if you're a value investor. But I think you go in a little bit. And the only reason I say that is because if we have a recession in the next year, then GE is still in trouble. They haven't turned the corner that far yet to where they have enough, where they've cut their long-term debt. There's still a large amount of long-term debt here. But it's declining at a nice rate.
Yeah. If we had a recession next year, a lot of companies are still in trouble because they cut their payrolls down to the bare minimum in order to raise their bottom lines, even though revenue's been stagnant. So, a lot of companies are in trouble, if we go into a recession next year. But that being said, I mean, hey, I'm happy. I want to see GE continue to grow because it's an American company and, it's been American owned and it's really pushed those values out there and really grown. But China has actually gone. There was the latest article I went on Fidelity before we began the show, and I read the very top article. The very first article on Fidelity under news for GE was about how China is going to limit imports.
Really?
Yes. Top news article right there. So to me, there's some hesitancy. I see a strong division in the jet engines and the wind turbines, especially jet engines now because, the airlines got rid of all their old airplanes during the COVID pandemic and they need to re-up. And so it's a great business right now for GE in that regard. And that could be the boom you're seeing right now because they get the orders placed and paid for it. And then, you don't see them actually on airplanes for another 2 years.
Well, and it's totally a recovery play. They also have some fingers in healthcare as well.
There you go. See? All right. Cool.
Now, this other question that I have for you, given that this company's been, this company traces its roots over 130 years. I saw that a New York university finance professor said that there will no longer be any 100-year companies from here on out because of tech. I disagree. So, my list that I would look at, I would say Apple and Microsoft absolutely have a good chance of getting to 100 years.
Is he talking about new 100-year companies?
He's talking about companies. He actually said there's no chance that companies today will last for 100 years.
Amazon.
I think Amazon will. Now,
SpaceX.
Now, who knows where Amazon will be in 100 years? Look at the chart of General Electric over the last 30 years. This is one of the reasons why that whole idea of buying a stock and then not looking at it and just letting it sit for decades because it is a good stock when you buy it, that doesn't work. Look at that. At one point, GE had a market cap of over $400 billion. It was the world's most valuable company, I think. And now it's down to the 90th most valuable company.
Yeah.
So you need to be at least a little bit active. At the very least, if you're buying individual stocks, paying attention to those earnings.
Well, I believe that people you hear saying that are of a generation, Brandon, that came before you and I. They're a generation that they grew up with these big industrial companies that like I'll give an example of P&G. You could put money in P&G in the 50s and 60s and let it sit, and it would grow and grow and grow and grow, right?
Yeah.
But if you and I look at P&G from 2000 on, we see a different picture.
Right. Or Macy's.
That's not a lot of big return,
In retail, Macy's or Sears.
Yeah. So, for people of a certain generation, yes, that's how they view it. And, things change, though. You have to look at your portfolio and always manage it efficiently. So what I always say, if you have a 401k, folks, what I say is look at your 401k once every 6 months. I say whenever you turn the clocks forward or back, what you need to do is A, you need to go up to your smoke detectors and change out that battery.
Yeah.
B, you need to turn on your clocks forward or back. And C, you need to take a look at your 401k and your investments and see if they're still right where you want them to be.
Yeah.
You know, I always say there's a whole list of things I do. When I turn my clocks forward and back, I'm only busy twice a year. That's it.
My 401k last year, right around probably November, December, after it started to look like the market was getting overheated, I switched mine to small caps, mostly, which is a little bit more aggressive, but I thought small caps had more of a growth to go, and they did. And now I'm looking at changing it back to being more conservative and more dividend-oriented.
So I do things like that you can do with your 401k. It's your money, folks. Do some research, find the best return. You know, take a look at your finances and see how you can get the most out of your money.
Yeah.
You know, I don't want to just hand my money over to someone and they give me a 5% a year return. That's awful.
Right.
Awful. When I teach, Brandon and I get on the show and teach you that you can do 5% a week every week.
The reason why I went dividend oriented is because I think that with rising rates, because I do see them stopping the bond program at some point in time, even if they don't want to do it, they're going to have to do it. And rising interest rates, people are going to be chasing yields, and the comparable stocks are going to be the ones that have the best dividends. Yep. So
there you go.
That's why I like Lockheed Martin. It's got a good dividend.
All right, Brandon. Let's make this. Let's. What do you say? You cut the show right here.
Yeah, we're at 37 minutes.
Yeah. Let's just go ahead. Final thoughts. You first.
You know, just don't just buy and sit on it. You have to pay attention to what's going on. You don't have to look at your phone every day. If you're an investor, you don't have to check it every day. You can aim to do what we talk about, that 5% a week. Or you can, you know, if you're a more passive person, that's fine. But if you're the person that wants to just buy something and not look at it, then own SPY and, you know, an index fund like SPY, and then just put money into it like every month or something, if that's what you want to do. But I do think that GE could be a great turnaround story. I'm not willing to die on that hill, so I'm just dipping my toes into it. But
I tell you what. On the long term, since we're talking long term investments here right now, as far as long term investments, again, I stressed that like twice already. DD Global, I have built a fort on this hill. I built a home on this hill. I'm raising my flag. I'm dying on this hill. So it's a long term investment for me, and that's where I'm planning my home.
I've got pretty high conviction for DD. They're going to be around. They're not going to. They might go private again, that'll be a weird situation if they do. But
if they go private at the price they've mentioned already, I'm profitable.
Yeah, you're good.
I take a nice
at $14.
Yeah. I take a nice hefty profit. So I'm happy.
Yeah.
You know, I come out a winner.
And then
and if they don't, I come out a winner anyway. So.
Alibaba's earnings are tomorrow. That'll be something interesting to watch too.
Right. All right, guys. Follow us on Instagram. Please follow us on Instagram. Take a liking to us. We appreciate you listening. We'll keep you updated. We'll try to post as much as we can to Instagram. We are looking at updating our website here very shortly and starting out those email subscriptions getting out there to you guys. We appreciate your support. Please follow us. We hope we've been entertaining, education, uplifting, because we want everyone to make money. You have a good night.
Have a good night.